Cleveland, Ohio, October 1973. A woman named Dorothy pulls into a gas station on Pearl Road at 5 in the morning. The line stretches 3 blocks. A hand-painted sign on the pump reads, "For gallons maximum." Last week, there was no limit. The price has doubled in 6 weeks. By January, it will triple. Dorothy has $5,000 sitting in a savings account at Cleveland Trust. It pays for 0.5%. She believes that money is safe. It is not. Over the next 12 months, inflation will silently consume a third of its purchasing power, and she will not understand why until it is far too late. Pattern introduction. Now jump forward. Tehran, 1979. The Shah has fallen. Iranian oil vanishes from global markets overnight. All doubles again. The Dow sits exactly where it started the decade, a lost 10 years for anyone holding stocks. Jump again. Baghdad, 1990. Saddam invades Kuwait. All doubles within weeks. Recession follows within the year. Same trigger. Same sequence. Same devastation for anyone holding paper. Every single time. The present 2026. Here is what keeps me up at night. Right now, in 2026, the Strait of Hormuz is closed. Oil has surged past $100 a barrel. Analysts are no longer ruling out $200. Iran has publicly promised to make it happen. This is not theory. This is 1973, happening again in real time, on top of a far more fragile global economy. By the end of this video, you will know exactly which 4 assets survived the last oil shock and which ones were quietly destroyed. Stay with me. And before we go further, this is history, not financial advice. Do your own research. The pattern: every oil shock follows the same sequence. A choke point closes. Supply vanishes. Prices spike. Inflation surges. Central banks panic. Paper assets collapse. And then the wealth transfer begins from the unprepared to the prepared. 1973. Arab producers embargo the United States after. Nixon sends emergency aid to Israel during the Yom Kippur War. Oil goes from $3 a barrel to $12, a quadrupling. The stock market loses nearly half its value over the next 2 years. Recovery takes almost 7 years, not months, years. 1979. The Iranian Revolution pulls Iranian oil off the market. Inflation surges into double digits. The Federal Reserve panics. By 1981, the 10-year Treasury yield reaches nearly 16%, destroying anyone holding long-term bonds. 2026. The Strait of Hormuz closes. 1/5 of global oil supply vanishes overnight. The largest supply disruption in the history of the global oil market. The International Energy Agency releases the largest emergency stockpile in its history. It barely moves the needle. The daily shortfall is 15 million barrels, the entire daily output of the United States. There is no easy replacement. Same choke point. Same spike. Same panic. The question is not whether the pattern is real. The question is what you own when it hits. Asset number 1. Gold. Here is what most people still cannot believe about the 1970s. Gold did not just beat inflation. It destroyed every other asset class. And it was not even close. When Nixon closed the gold window in August 1971, gold sat at $35 an ounce. By January 1980, it hit $850, from $35 to $850 in less than a decade. Stocks lost purchasing power every single year over the same period. Bonds lost even more. Gold gained 9% per year after inflation. The mechanism is simple. When energy prices spike, everything denominated in paper loses value. Gold is not denominated in paper. No government prints it. No government borrows it into existence. Here is the detail most people miss. 1 month before the 1973 embargo, OPEC passed a resolution complaining that the dollar's collapse had already robbed them. They began pricing oil against gold, not because they loved gold, but because even the people selling the oil did not trust the currency they were selling it in. Research by Hams and Wills proved something remarkable. Before the embargo, the price of oil measured in gold had already dropped by more than half. The so-called oil price spike was not just politics, it was OPEC reclaiming purchasing power. After the spike, the price of oil in gold terms returned to exactly where it had been. Measured in the one currency governments cannot debase, nothing actually changed. The crisis was a repricing, not a shock. Right now, gold has surged past $4,500 an ounce, briefly touching $5,000. The pattern is active. Asset number to Farmland. This one surprises people every time. During the 1970s, Farmland was the second best performing asset class in America, behind gold. The USDA tracked it. American farmland went from $137 per acre in 1970 to $737 by 1980, more than 5 times in a decade. And that does not count what the land produced. Beef prices doubled. Corn nearly tripled. Wheat quadrupled. The land appreciated and the output appreciated simultaneously. The mechanism is straightforward. Modern agriculture runs on oil. Tractors burn diesel. Fertilizer is made from natural gas. When energy prices spike, food prices spike with them. The cost of food rises. The value of land that produces food rises with it. And unlike gold, no federal government has ever confiscated farmland during a financial crisis. Not in 1933, not ever. There is no executive order for farmland. A government that seizes farms creates a famine, and even the most desperate administrations understand that math. Quick note to the viewer. If you are realizing that the assets your financial advisor never mentions are the ones that actually survive oil shocks, you are in the right place. This is Fiscal Historian. I study the autopsies so you can see the patterns before they repeat. Subscribe if that matters to you. Asset number 3: energy stocks. With the critical warning over the full decade of the 1970s, energy stocks crushed the broader market. An equal basket of Exxon and Chevron, held through the decade, returned 5 times what the S&P 500 delivered. But here is the warning the history books quietly omit. During the very oil shock that should have benefited energy stocks the most, the 1973 crash, that same basket lost nearly half its value, right in line with the broader market. Let that land. Oil quadrupled. Energy stocks still got cut in half. The mechanism. In a liquidity panic, everything sells. Margin calls do not care what you own. Energy stocks recovered faster and climbed far higher, but only for investors who survived the initial crash. If you sold at the bottom, the long-term returns meant nothing. The Nifty 50 told the opposite story. Polaroid, Xerox, Avon, the blue chip darlings everyone loved, trading at 50, 60, 90 times earnings. When the oil shock hit, they collapsed. Most never recovered. Polaroid went bankrupt. When inflation surges, the market stops paying premium prices for future promises. It demands value today. Asset number 4: short-term government debt, the boring one. And boring saved a lot of people. Long-term treasury bonds were destroyed in the 1970s, a fixed yield that inflation ate alive every single year for an entire decade. But short-term treasury bills, the kind that matured in a few months, kept rough pace with inflation. They roughly broke even. Not exciting. But breaking even while stocks crash and bonds bleed is not boring. That is survival. The mechanism is duration. Short-term bills reset their rates as inflation rises. Long-term bonds are locked in. Duration killed bond investors. Short duration saved them. What went to zero? The real story: savings accounts. Dorothy in Cleveland with her $5,000 at Cleveland Trust. The bank paid her 4.5%. Inflation ran at 12%. She was effectively paying the bank to slowly destroy her purchasing power. She just did not know it. And here is what the history books consistently skip. The people hurt worst were not gamblers. They were the most conservative, most responsible savers in America. The people who did everything right, who saved diligently, avoided risk, trusted the system. They were the ones quietly wiped out, not by a crash, by slow, invisible erosion. While their government told them everything was fine, the warning SIGNS: now the Strait of Hormuz is closed. The Strategic Petroleum Reserve can release 4.5 million barrels per day. The daily shortfall is 15 million. The reserve cannot fill the gap. It buys weeks, not months. Southeast Asian nations are already rationing fuel. Thailand and Vietnam have run dry. People cannot get to work. Every mechanism that helped the world absorb the 1973 shock, spare capacity, alternative producers, emergency reserves, is weaker today than it was 50 years ago. The pattern is visible. If you are willing to look close. Dorothy waited 3 hours for 4 gallons of gas at 5 in the morning. She did not know she was living through a wealth transfer. Nobody told her. The newspapers called it a shortage. The government called it temporary. Her bank told her savings were safe. Meanwhile, Bunker Hunt bought silver at $3 an ounce because he had studied Weimar and understood what happens when paper currencies lose their anchor. He was right, until he got greedy with leverage and the government changed the rules. But his instinct was correct. Physical assets outside the banking system held their value when paper assets did not. Dorothy trusted the system. Bunker Hunt trusted history. The pattern is mathematical. The outcome is inevitable. The only variable is what you choose to do before it arrives. This has been Fiscal Historian. Go diversify before you are forced to.